And this is a big reason why. A lot of the index companies out there and you'd recognize a lot of them that are at the top, utilize a variable loan on an indexed universal life policy. Now, to me, having the word variable, having anything to do with a loan or income that I'm taking out scares me to death. If I've sold an index universal life policy and I've done this great job in conjunction with the client for 15, 20, 25 years of protecting my client from any downside risk whatsoever to any of my principal, why on earth, when it comes to the most important part of that policy, that is the income stage, why would I want to put any of that income at risk? And that's really what you're doing to a point. You can't lose money on it, but then again, you may not have a consistent income because your variable loan can move on a month-to-month basis. And that's really where a variable loan, you need to take a look at the fine print on it, because as you see by the numbers here, again, with our participating loan contractually guaranteed at 6%, a variable loan rate with most companies is often based on the Moody's bond yield, the average that's used. If you see the numbers there, the 20-year is almost a little over 7.25%. The 20-year is almost 9%, and the 20-year is almost 9%, as you can see, and then that 20-year average being closer to almost 8, somewhere in that 8 to 9% range. The thing about the variable loan rate is if you look at the companies that are utilizing loan rates right now, most of them are illustrating a loan rate somewhere in that ballpark of 5.5 to 6, maybe 6.25%. Now, history dictates, or history has shown us, at least on a calendar year basis, that those numbers are probably being overly aggressive based on 20 years, even 50-year Moody returns. So, again, to me, that's a big difference, because if I'm showing an illustration today that plans on 20 years from now, my my variable loan rate at 5.5, but when it comes to taking my income out, it's at 750 basis points higher, or 7.5, or 6.5, whatever it may be. That's going to blow my income right out of the water. So there goes my plan, which again speaks, if you haven't figured it out by now, that with me preaching about how illustrations are not worth the paper they're printed on, and the only thing guaranteed is it's not going to be correct, the variable loan plays into that as well. The other thing, which is probably even more important about the variable loan, is you got to look at the fine print. Most companies in their fine print, their maximum loan rate on a variable loan rate could be 10 to 12%. So imagine if I'm illustrating 5.5 today, and the worst case scenario happened, or even close to the worst case scenario, where I'm at 8.5, 9.5%. That is going to do some serious damage to my plan as far as retirement income is concerned. So with a variable loan, it's something, again, that to me, putting it on the chassis of an index product, it's very confusing to me, because to me, to put anything at risk on the most important part of the policy just doesn't make any sense, considering what the plan was all along, to protect the client from downside risk. We got a piece, too, and this is just a quick snapshot of it, that we certainly can get to Bravada, and I'm sure if they don't have a supply of these, we'll certainly get them out to you. But this is another piece that you should have in your arsenal if you're showing an index universal life. Remember, the other two pieces were the cap renewal piece that shows Allianz's strong history of renewing caps at near or greater than what they were introduced at. That market capture piece, which shows the crediting methods and gives the client and an agent a better idea as far as what percentage of the actual index or market is being captured by each individual crediting method. And then there's this piece, which basically shows that slide I showed earlier that compares policy loans when it comes to participating or variable, and talks about the advantages and disadvantages. So a quick summary of the loan piece. With Allianz, we do have the fixed loans. Depending on a wash loan or a net 2 cost, they're available in the first 10 years at a net 2, and a wash loan in anywhere after that 10th year. The participating loan, which technically is fixed because it's a 6% fixed contractually guaranteed rate. And then you've got variable loans, which, as you can see the question mark there, we not only do not know what they're going to be next month, the month after, let alone the year after, 5 years, 10 years after. All right. One last piece on the loans before we jump into the sales concepts. We've got a loan protection rider, and I think most companies should have this rider. If they don't, they certainly should, because it not only protects the company, but it protects you as the agent from any potential liability in the future. And really what it does is it dummy-proofs the policy, because by putting this rider on there, it will not allow the client to take out too much money or too much income to lapse the policy, which we all know if you've taken out income over X amount of years and you lapse your policy, all that tax-free income that you took out is now going to be taxable, and I don't think anybody wants Uncle Sam showing up at their door to collect taxes 5-10 years after you've taken all that income out without any taxable consequences. So really the technicality of what it does is when their loan balance reaches 90% of the accumulation value, what they do is they adjust everything, so therefore there will not be any kind of, they adjust the death benefit down. I won't say it becomes a reduced paid up. It functions in that capacity, but technically it's not a reduced paid up. But it dummy proofs the policy. I'll recommend that anybody that writes an index universal life policy with Allianz, put this on the application. And the reason for that is that you cannot add it after the fact. Once the policy is in force, you cannot add it after the fact. It doesn't cost anything to put it on the policy. There's only a cost if they utilize or exercise the rider, and it's a small cost. I want to say it's 5% of the accumulation value, which is pretty standard in the industry. So put it on every index policy that you sell with Allianz, because there's no cost up front, only a small cost if they decide to utilize taking out income. Well, I should say if they decide to utilize the rider, because technically they could take income out without even utilizing the rider. But again, with it offering a dummy proofing of the policy, it's certainly worth it, in my opinion, to put it on there ultimately, regardless of what the plan is. All right. Let's wrap it up with just a couple of quick sales pictures, or I don't want to call them case studies because technically they are, but it's really a look at how the policy fits. So with this first one, we've got and these probably are going to be very familiar scenarios, but don't get caught up in the numbers of these as far as premium. I mean, if you look at that third bullet there, you see $180,000 combined salary, and I'm sure some of you, if not all of you, have clients like that, but I guarantee all of you, or some of you, most of you, have clients that are on the lower end of that and can only fund a policy at target. So don't get caught up in the numbers of it, because you'll see here on an upcoming slide that even funding this at a target premium also gives the client a very viable option for a retirement income. It's all relative to what a client can afford, and that's probably a good rule of thumb when it comes to most financial pieces, but again, it's all relative to what the client can afford. So again, the common need, the life insurance to protect his family should he die prematurely. We're going to fund it for about 27, 28 years. He's going to retire at age 67, so he wants to stop paying premiums at his retirement age, which is very common for indexed UL, and then wants to access the cash as his tax-free income in retirement. All right, so here's a quick snapshot and gives you an idea as far as what the numbers look like. Target premium on this case for a $500,000 death benefit is going to be $6,191 for a 40-year-old male at our second best risk class. This is our best risk class in this scenario. So $6,100 is the target premium. I fund it for 27 years at age 68, based on an 8% rate of return, and we're utilizing a participating loan here. I would have income from age 68 to 120, if I made it out that far, of $31,584. So I've put about, just shy or just a little over $167K in over that 27 years, and it takes me about 5 years to make all that back in what I've taken premium out, and then I've got income of $31,584, again, based on my illustrated rate and my participating loan, carrying that all the way out to age 120. On the flip side, if I want to max fund this based on my variables, I could put as much as almost $20,000 in there. If I do that based on my variables, I've got about $2 million and some change in cash 27 years later, and it takes me about 4 years to get that out in what I've put in premium outlay, and then it still runs out all the way to 120. And again, you've got about $123,000 in cash, so not a bad tax-free income as long as they're following the rules of the policy. Now, the one thing I'll mention too is you load on the right-hand side of your policy lapses. These are based on the current side of things. You do see these white boxes are based on the guaranteed side, and they run out obviously at 68 and 71. Keep that into perspective. Again, don't get wrapped up in the illustration game. because you have to keep in mind what comes into play on the guaranteed side of things. Number one, it assumes that you're allocating everything to the fixed bucket from day one through, in this case, on the target premium, through age 68, so 28 years. And you don't change that. And it also assumes that you're only getting the minimum guaranteed rate of return in that fixed bucket of 2%. Not only that, but it also assumes that Allianz is in such poor condition as a company that we have to enforce our highest cost of insurance policy for premium charge, all the fees within a policy, all that happening from day one of purchase for 28 years. Now, I don't know about you, but if I think that's going to happen, I don't really think an index universal life policy is what I should be selling that client for starters. Second of all, if that happened 1 year, 2 years, 3 years, let's just say that started to happen, I don't think you're going to keep your money with a company that at day one drops the interest rate to the minimum and also enforces all of the costs of the policy at maximum cost. So the two things there to keep in mind: you're not going to keep your money with a policy or a company that does that for starters. But second of all, it would have to happen for 28 years in a row, and that's not the right product if that's the mentality of the client.